Yes.
Okay. Well, good afternoon, everybody. This is Jeff Stein. It's like I'm on the radio. It's nice to see everybody. I'm Jeff Stein, and what a pleasure having you all here today. We're so fortunate to have Tom Antonovich talk to us about Social Security. He is excellent in his presentation, and I'll go into just a touch more detail in just a moment. I do want to remind everybody that we're going to be recording this webinar today so that we can share the information with clients who are not able to attend. If you're uncomfortable with that, please feel free to disconnect now. If you don't wish to be on video, please ask your questions through the chat feature, and one of our team members will ask the question for you. A little bit of trivia. Well, I don't know about trivia, but a little data that I think will be helpful. Social Security's COLA, or cost of living adjustment, is linked to the Consumer Price Index, the CPI. There's a subset of CPI known as CPIE, which tracks elderly spending. That, I guess, would indicate people like myself. Those expenses have grown more rapidly year over year, but the COLA adjustments don't reflect those growing expenses. So Social Security benefits have actually lost 30% of its buying power since 2000. And that was a statistic from MarketWatch at the end of last month. I think it just points out, first of all, the importance of Social Security, and secondly, how important it is to keep in mind that the benefit itself will get smaller as time goes on because of inflation, and in turn, the importance of making sure that other dollars that we might have keep pace and help to offset that decline that's being caused by the inflation. So to move on, I'd like to introduce you to Tom Antonovich. He's a vice president and senior advisor consultant representing Franklin Templeton here in Minnesota. As a trusted business partner of ours, he brings valuable perspective to our group in the areas of practice management, asset allocation, and portfolio construction. Tom is a FINRA registered representative and holds the designations of CIMA, CAIA, and CFP. He earned a bachelor's degree in finance from Iowa State University and currently resides in Chanhassen with his wife Danielle and their 3 children. Tom, thank you so much for being part of our presentation today. I am personally looking forward to just getting a little bit smarter about Social Security and putting myself into a position where I can make more informed decisions about when to start, what the benefit's all about, how the benefit's calculated, etc. So Tom, please take it away.
Sounds great. Thank you very much, Jeff. And thank you all for giving me a piece of your afternoon this afternoon. It's really nice to be here. And I think we're going to have a very informative discussion about something that is a very important piece of their financial pie. I'll tell you a little bit about myself and how I got into this business. I grew up in Sioux City, Iowa, which is in the northwest corner of Iowa. I was a little bit of a throwback. My mom and dad got married in 1950. So they were literally products of the aftermath of the Great Depression. When it came to investing, there were checking accounts, savings accounts, and CDs. I think, a lot of folks in that era were like that. Their investment decisions were formulated during the aftermath of the Great Depression, and that's how they went about things. So maybe you had folks like that or grandfolks like that. And that's when it got me sparked to be in this investment business, is that, you want your money to work as hard for you as you do for it. And you want to maximize the opportunities when you're given the chance. And I think Social Security is a very important piece of the pie. My father passed away in 2005. My mom just passed away last year. So, my dad ran the finances, he worked, and my mom had really, just because of their prudence and their planning, that was a very, very important piece of her financial pie for 15 years. So just knowing the facts, there's a lot of information and misinformation about Social Security. So today's presentation, what we're going to do is we'll take a look at the history of security, what it would look like in 1940 when it was first launched by the FDR administration. We'll take some time and we'll unpack, which is the top of mind with a lot of clients today, is what does the projected cash flow of Social Security look like? So We'll take a look at the 70-year projected cash flow, just so you better understand the numbers and you know the truth behind those numbers. And then we'll take a look at a couple of case studies, comes death and divorce and options to enhance your Social Security over time. You know, what those decisions might look like in terms of your benefit. So with that, do I have the option here, Lauren, to share my screen?
Yep, right at the bottom, that share screen button.
Okay, yeah, it says host disabled participant screen sharing.
There you go. Should be able to now.
Okay, let me give it a chance here. Okay. How does that look, everybody? Social Security, Security and Social Security today, tomorrow, and for the future.
We got it. And the only other thing, Tom, is if you could re-enable your camera. I think that got switched off.
Yeah, I just thought maybe you want me to. Okay, that's fine. If you wanted, okay, that's fine.
Perfect.
Let's take a look. So Social Security then, now, and for the future. So Social Security is funded by payroll tax. In 1940, you know, it was planned for a while. It took a while for the FDR administration to issue Social Security numbers and get the infrastructure to support Social Security set up and running. And back in 1940, the payroll tax was 2%, 1% for the employer and 1% for the employee. Today, it's 15.3 all in, divided by the employer and the employee. The earnings cap in 1940 was $3,000. Today, it's $132,900. That's adjusted each and every year for inflation. So the way you want to think about that is, you know, anything above $132,000 on annually is not currently taxed for Social Security purposes. So I think about some of the Minnesota Twins players and some of those large contracts that they're signing nowadays, and literally their Social Security earnings cap is earned, you know, the first game or two that they play during the season, and after that, it's not currently taxed. I mentioned that because we'll come back to that a little later today. Total beneficiaries in 1940, they had to start somewhere, so they drew a line in the sand. If you qualified at that time, you were a beneficiary. And back in 1940, it surprises a lot of people that there were over 222,000 people that qualified for the Social Security benefit. Today, Anthony, it's just a little bit higher. It's over 68 million Americans currently drawing Social Security. 68 million. And think about the fact that, you know, over the next 10 years, that entire baby boomer generation is going to be passing through. Very large number. It's on the top of a lot of people's minds. Back in 1940, there was 159 workers supporting every one beneficiary. This has got a lot of people worried. You know, today, the worker to beneficiary ratio is about 3 to 1, and we'll address that. The average retiree benefit in 1940 was $22.60 a month. That might not sound like a lot, but you know, it was enough to put 3 squares in your belly. It's enough to give you a warm place to sleep at night. You may have had to share the facilities with another family or two, but it gave you some of the necessities. And it was never intended to provide everything. It was identified to help supplement, you know, your living in retirement. Today, the average retiree benefit is over $1,461 a month. So those are the numbers 1940 through today. And when you look at Social Security and you think about it in its simplest form, you know, it's a government-sponsored, inflation-adjusted, lifetime retirement income. You're in great financial hands with the Stein Financial Group. They have some of the greatest investment minds partnering with them to help secure your retirement and provide income for you and Anthony with portfolios and whatnot. But no investment firm has anything that can directly compete with Social Security because of the government sponsor, because of the inflation-adjusted lifetime. We have things that can complement it, but in and of itself, it's a very, very powerful asset on your family's balance sheet. And you should think of it that way. You have a lot of information and misinformation when it comes to Social Security, especially during years where there's an election, right? With 68 million people drawing in that whole baby boomer generation, people are paying attention to the rhetoric when it comes to Social Security. So I thought this cash flow, it looks very busy, but we'll spend a few minutes just to unpack this so you can better understand the numbers, okay? In this particular chart, the source is the Social Security Administration, the annual report of Board of Trustees. This is the actual report that gets supplied to Congress every year. So Congress understands these numbers better than anybody, and they get this updated on an annual basis. It doesn't seem to stop some of the embellishment of the record, but nevertheless, we're here to kind of provide some clarity for you. So I want you to think about 1940, there's about 159 workers for every beneficiary. You could imagine that the Treasury Department was taking in quite a bit of positive inflow, right? With 159 people paying in for every one beneficiary. So Congress actually had the foresight to set up two trust funds. One trust fund was for disability and one trust fund for retirement benefits. And they went to the Department of Treasury and they issued special Treasury securities. So all of that extra inflow could actually earn a safe amount of interest. So for the better part of 60 years, that cash flow was earning interest in these trust funds. It's important to remember that because when you look at the blue line and the green line is the payroll tax that we looked at earlier that's supporting the cash flow for Social Security. And if you notice, that green line was above the blue line, which is the cost and scheduled payable benefits for Social Security until 2009. And in 2009, you'll see that the blue line, the cost of the payable benefits actually eclipsed. It was higher than the amount of income that was coming in. So if you turn back the clocks to around 2010, somewhere in there, you heard more and more things about the Social Security being more of a Ponzi scheme. And that can't be true. By law, Social Security cannot pay out more in benefits than it takes in. But I can tell you this, we were able to fully fund those benefits because of all of the interest that we earned in those trusts for all those years. And the way the timeline works out is in 2021, the interest will be paid out and they'll start cashing in the Treasury bonds themselves. And that should flow full benefits till 2035. At that time, you'll hear more about it. I've heard it a couple times over the last few months, whereas in 2035, Social Security will become technically insolvent. And what technically insolvent means, I've done these workshops, about 25 or 30 of these workshops now. And when we're able to live ask people what that means to them, most of the people say, that means if it's technically insolvent in 2035, that means my benefit's going to be zero, right? That's what they think when they hear the term technically insolvent. But the way what technically insolvent actually means is if nothing's changed between now and 2035, the payable benefits will be approximately 80% of what you're scheduled to receive. So if you're scheduled to receive $2,000 per month, if nothing's changed, you'll receive $1,600. Now, 80% is by no means ideal, but it's not zero, right? And I can tell you that they have 15 years to fix this. Reagan and his administration came in, they championed a blue ribbon committee to study the effects in the cash flows of Social Security. A very obscure economist at the time led that blue ribbon committee, a gentleman by the name of Alan Greenspan, right? And they did a think tank and they came out with a solution, a number of resolutions that would extend the life of Social Security. And they needed to, because there wasn't any major revamps of Social Security prior to that time. And people in 1980, in the early 80s, were living so much longer than the people during the 40s. Just the demographics shifted so much that it required a fix. So they did, and they'll have to fix it again. And now, what are some of the possible solutions that they could have at their disposal to help fix this this deficit of 20% in scheduled payable benefits. There's a number of them, folks, but I'll just highlight three. Number one, you know, over the years, they increased the working age, Social Security, from full retirement age from 65 to 66, and then they moved from 66 to 67. They did that twice before. My guess is with the demographics and everybody living so much longer, they may have to consider doing that again. The second potential fix would be making the younger generation work a little longer. We'll see how that works out. The third potential fix is increased taxes. And I know not everybody wants to increase taxes, but if that's the only lever that they pulled, this is a statement from the 2019 Social Security Trustees Report. And it says, for the 75-year projected period, the deficit is 2.78% of taxable payroll. Decreased, actually went down from the previous year from 2.84. So that 2.78% deficit means this. If the only lever that they pulled to fix Social Security would be increased taxes, they didn't do anything with extending the retirement age, and they didn't have the younger generation work any longer. All they did was increase taxes. The deficit is about 1.39% for the employer and 1.39% for the employee. It's roughly $14,000 for every thousand earned, and that alone would potentially fix Social Security for the next 75 years, right? So they can fix it. They know the numbers. I would focus on something that you can control, you know, and not worry about this, because they have 15 years to fix it. And if history is a guide, they'll take 13 or 14 years, but it's very manageable. The right age to file is more important. So this is the one thing that you can control. If we all knew when we were going to pass away, it's an easy answer, but we don't. So we have to hope for the best and plan for the worst. So here's a couple of statements from some extraordinarily smart folks that study this subject. One is the Life Insurance Institute for Secure Retirement. And they say for a 65-year-old couple of average health, there's a 50% chance one of them will live to 93 and a 1 in 4% chance that one will live to 97. Claiming Social Security early, which we'll look at on the next example, would lock you into a smaller payout for potentially 30 years or more. And Dr. Richard Thayer is a gentleman, he's a professor at the University of Chicago. He just won a Nobel Prize a couple of years ago with his work in behavioral economics. But his opinion is this: if you're in good health, you can afford to wait. His advice is that you should wait as long as possible. The greater your guaranteed income, the easier it'll be for you to organize your retirement budget, and the less you'll have to worry about living too long. So we're literally planning for 25 and 30 plus years of living after retirement. So we're going to shift gears a little bit. We'll look at a couple case studies and to kind of draw upon what this lifetime asset for your family might look like. So here's Sarah. She was born June 5th in 1957. Her full retirement age, the FRA, full retirement age, is 66 and 6 months. Her full retirement benefit is $2,317 per month. And she comes from good genes. She's expected to live to 95. So here's her hypothetical benefit payment. If Sarah were to pull early, right, at 62, she's eligible. That would give her a haircut from her full retirement benefit of $2,317 a month, and it would be estimated to be around $1,420. You take a 25 to 30% haircut when you pull early. If Sarah were to draw for 18 years and live to 80, the full retirement benefit is over almost $405,000. If she were to live to age 90, her estimated lifetime benefit was over $742,000. This is the lifetime asset aspect that I was talking about, and how to think about this benefit, not just in terms of the benefit, but think of it as a lifetime benefit. It's just a different way of thinking about this cash flow that comes in per month. If Sarah were to wait to her full retirement age, obviously she no longer takes a haircut. So she would be receiving her entire $2,317 per month. Even though she's pulling for 4 years and 6 months less, if she were to live to age 80, look at her benefit compared to pulling at 62. Her benefit would be over $477,000. And if she lives to age 90, in spite of pulling 4 years and 6 months, that's how much that haircut costs you over time. And she lives to age 90, her total estimated benefit would be $966,000. From your full retirement age, folks, till age 70, you earn what's called as deferred credits. And those deferred credits add up to be roughly 8% a year. So if she were to wait to age 70 to pull, there's no reason to wait till after 70 to file Social Security. Your Social Security is absolutely maxed out. But for those 3 years and 4 months, she'd be earning deferred credits. So her benefit would go from $2,317 a month to $3,549 a month. I know there's a lot of numbers to digest here, but it just gives you a feel for how impactful these things require over time. Even though she only draws for 10 years to age 80, her benefit is higher than the other two scenarios. Her total benefit at age 80 would be estimated to be $495,000. And if she lives to age 90, her lifetime benefit is over $1.15 million. And just, we talked about a government-sponsored, inflation-adjusted lifetime income stream. This is how much money you'd have to have laying in the bank account, prepared to write a check for, to the insurance company to provide that type of income. And that's why I thought it's really important to understand the impact of your lifetime benefit of when you draw is being a very important element. Hoping for the best, preparing for the worst. Some people at these seminars think, well, since I'm drawing for 8 years more, wouldn't my benefit be much higher? And that's not the case because of the haircut. So you can see, somewhere between, in this example, somewhere between $495,000 and $1.1 million lifetime benefit. It's a very important asset. Stopping, suspending Social Security. So by filing at 62, it reduces your benefit depending on your full retirement age by somewhere between 25 and 30%. Full retirement age starts to increase from 66 to 67. We talked about how they extended that the second time for those folks born in 1955. But you don't have to work the whole entire year. So if you were born in 55, you had to work an extra 2 months. If you were born in 56, you had to work an extra 4 months. So it wasn't like you hit that timeline and had to work a whole nother year. They did it in 2-month increments until it went to the next age bracket. So if you're under full retirement and you wanted to stop receiving your Social Security, you can do that if you started within 12 months. So what you need to do is you'd have to file a request for withdrawal of application. It would require you to repay all the benefits that you received, and also anybody that may have received a benefit on your behalf. And you had to repay any Medicare premiums deducted from your checks. But if you started Social Security and you thought you made a mistake, you can still redo it if it's been within 12 months. A lot of people don't understand that. Once you reach your full retirement age, you can suspend your benefit anytime. And all you have to do is call Social Security, tell them to suspend your benefit. There's no repayment required. Just remember, you'd stop receiving a check at that point, and anybody that was tied to your record would also stop receiving a check going forward, but it would not require you to repay any of the benefits that you had accumulated up to that point. And we'll give you an example. We'll look at these are the bunkers, if you remember, all in the family from the 70s. We try to put a little story behind some of these characters to make them a little more entertaining or a little more memorable. So you got Archie and Edith here. Archie, 63, Edith, 61. So Archie worked at the golf course for over 20 years, and just the urban sprawl closed down the golf course and in replace of a shopping mall. So Archie was forced into retirement a little earlier. He started at 62. Edith had been a math teacher at the community college until they started having kids. After Archie was around the house every day, all day for 6 months, she figured it'd be a good time to get back to work. It helped them make the cash flow work a little easier for their situation. So she went to the local high school to teach math. So a little bit of background. Thanks to Edith's job, they are more than meeting their current expenses. She absolutely loves teaching. She likes working with the kids. She likes to be out of the house. She likes to keep moving. And she plans to work until she's 70. Archie, now with Edith's newfound job and newfound passion that's been reignited, he has regrets. He wishes that he hadn't started Social Security early. Because he has a benefit because his benefit's a lot smaller, he's worried about making ends meet once Edith does decide to retire. So let's take a look at what Archie's situation is. So full retirement age of 66, estimated benefits 18 a month. Like Jeff said on the front end, the annual COLA, we're just using as an example, 3%. You have to make some assumptions with these numbers just so you can build a case. But from 62 to if Archie grew at 62 and he didn't know about this rule about suspending his benefit, he would have collected a lower benefit because he started early, $1,358 a month. And if he just collected that benefit, it was increased by the cost of living, and he lived to age 90, his total benefit received in this scenario was just over $701,000. If, on the other hand, Archie attended our workshop this afternoon and learned that he had options, and he learned about the deferred credits, he could have, since he had been drawing more than 12 months at the time Edith went back to work, he couldn't do anything. He couldn't call Social Security, repay his benefits. He had to wait till his full retirement age. So from 62 to 66, Archie collected almost $67,000 in benefit. But at 66, he called up Social Security. He asked them to suspend his benefit, which they did. Didn't have to repay anything. And then from age 66 to age 70, although he did not collect the check, his benefit earned a deferred credit. So you can see when he came off the other end and he turned his Social Security back on at age 70, his benefit was no longer $1,358 a month. It had jumped up to $2,209 a month. So his lifetime benefit, by canceling at full retirement age till age 70 and collecting those deferred payments, increased his lifetime benefit from just over 701 to almost $783,000. So just by knowing this rule, added about $82,000 to their lifetime benefit for this particular family. So that's Archie and Edith. That's starting, stopping, and suspending your Social Security benefit and how that may enhance your lifetime benefit over time.
Tom?
Yes.
Before we get going on this next example, could you
Sure.
mute all participants?
Sure, I can.
Awesome. Thank you.
I think I can do that. Lauren, do you have
Yeah, if you press participants, there should be a little gray button that says mute all.
you give great direction. Thank you. Very good. Is that better? Okay, good. So that's Archie and Edith. That's starting, stopping, suspending benefits and how that may enhance your lifetime benefit over time. This next example is Liz and Richard. And I'll tell you, Liz and Richard, what we're looking at here, folks, is divorce and what the rules look like when there's a divorce and when there's a widow situation. So, and how the numbers and how the rules change. So in this example, you have Liz and Richard. They started going steady at age 16. They got married when they're 20 and divorced when they're 32. Richard was a midshipman in the Navy. He mysteriously, when getting ready to deploy, he mysteriously fell off the back of the boat, and the Navy found him incompetent, and they discharged him. And as the story goes, Richard made his way up the coast from San Diego to Los Angeles, where his talents in Hollywood became recognized, and he became a very powerful movie executive in Hollywood. Liz, after the divorce, she struggled to make ends meet. She raised the kids, and she was married 4 subsequent times. Each marriage lasted from somewhere between 2 and 8 years. So we do that to show you, Social Security gets complicated. There's no doubt about it. But life gets complicated. So we're just trying to throw a few wrinkles into the situation with the divorce, with kids, and then subsequent marriages after the initial. So here's a look at their benefits. So they're both born on January 4th of 2016. They're both 62. Richard's full retirement benefit at 66 is $2,660 a month. Liz is currently single now, and her full retirement benefit's $800 a month. So we'll take a look at some of the rules with a marriage, okay? So minimum length of marriage is 10 years for spousal benefits. The maximum benefit that you can receive is 50% of your former spouse's full retirement benefit. The earliest age you can file for a reduced benefit is age 62. So some key concepts that people like to draw upon here is that your former spouse must have started Social Security, or if they haven't started Social Security but you've been divorced for 2 or more years, you're still eligible for a benefit on their behalf. Believe it or not, folks, this came up 3 times during individual workshops where people didn't know about that rule. It's a wrinkle in there. Even if you're entitled to a benefit, but your former spouse hasn't drawn, if you've been divorced for 2 years and not remarried, you could be entitled to a benefit. If you have more than one ex-spouse, the benefit is based on the ex with the highest benefit. You don't get to pick. You don't get all of them, and you don't get to pick. You get one, but it's based on the ex with the highest benefit. And in most cases, you lose your benefit when you remarry. So is Liz eligible for a benefit on her own record? Well, she's 62. She sure is. She's eligible. She would take a haircut, but she's eligible. And how many ex-husbands? Because remember, she got married 5 times, divorced 5 times. She's eligible for 1, and that's Richard in this case because his benefit was the highest of all of them. Can Liz choose which benefit? We covered that. She cannot. She automatically gets the highest. Can she receive her own reduced benefit and switch to a 50% divorce spousal benefit at full retirement age? That was a file suspend was a rule that the Bipartisan Budget Act of 2015 did away with. So you'd have to be 62 as of January 1st of 2016 to take care of that. Since they missed it by a few days, that rule has been phased out, so they can no longer do that. And then finally, if Liz needs a higher Social Security benefit, she could declare claim until she's 66, right? So she wouldn't take that haircut. So some key concepts now. Richard with his second wife, the Catalina Island, Jeff, I've never been there before. It's off the coast of Los Angeles, I understand. I heard it's just beautiful. But Richard was on a sailing trip with his second wife to Catalina Island, and guess what? He fell off the back of the ship again, right? But this time he didn't make it. So Hollywood's elite was devastated. However, now Liz goes from a divorced spouse to a widow. So the rules change, okay? So when the rules change, they give the benefit to the widow, right? It's a tough situation, and they carved out rules to give them more access to the benefit sooner. So in this example, the earliest age for Liz to now, because she's a widow, file for widow's benefit is 60. Remember the last example on divorce, it was 62, right? She's now eligible at 60 for a widow's benefit. The minimum length of marriage in a divorce is 10 years, but in a widowed situation, it's 9 months as long as you were married at the time of death. The maximum benefit in a divorce, if you recall, is 50% of your former spouse's full retirement benefit. In a widow situation, it's 100% of your deceased spouse benefit at time of death. And in the impact of the benefit received on other widowed spouses, In this case, Richard's second wife, there's none. So it's just a small pool. It doesn't affect a lot of folks, but one benefit from a former spouse has no effect, and nobody even knows about the other benefits that it's not affected. So from a divorce to a widow, you have some enhancements. You get to file 2 years earlier, 9 months versus 10 years, 100% of your former spouse's benefit versus 50. So far, so good. All right, so we're in the home stretch here, folks. We're a half hour in. I'm going a little over, so I apologize. But here's some questions. So Social Security, you have to earn 40 credits. Once you do so, you're eligible. Social Security benefit is based upon 35 years worth of earnings. And that's one of the reasons that your full retirement benefit is so much higher than pulling early, is that they look at 35 years of earnings. The highest earnings, so the lowest number drops off. So chances are when you're 60 or 61, 62, you're earning probably a little bit more than when you started working at 19, 20, or 21. So that 35 years, the lowest number drops off and is replaced, and that goes into the calculation, which is a higher benefit. You must file for Social Security, file for Medicare at age 65, even if you're still working, or your premiums will go up. That is not true. If you owe the IRS money, they can confiscate your entire Social Security check. That is not true. I believe they can take up to 25% of your Social Security benefit, but not the entire check. If your full retirement age is 66 and you delay claiming to age 70, so let's look at the spousal impact. Your benefit will be about what percentage higher compared to starting at 62? And it could be up to 76% higher. Instead of taking a 25 to 30% haircut, you're earning those delayed credits. A divorced spouse can get a benefit based upon the earnings record of his or her ex, even if their ex has not filed yet. That's true. Remember, even if they haven't filed, but you've been divorced for 2 years and not remarried, you may be eligible. If you wish you would have filed sooner, you can apply today, request a lump sum payment in the amount that you would have received up to that point. They're somewhat generous. They give you 6 months, but they wouldn't give you the full lump sum. And I'll tell you something. There was a gentleman, one of our keynote speakers. Her name's Gail Buckner. She was at an event in Texas where there were literally a few hundred people in the audience. And there's a gentleman who is 76 and quite proud of the fact that he hadn't started Social Security yet. And she had to break it to him that he missed out on 5.5 years of benefit. Folks, I tell you that story because there's no reason to delay beyond age 70. Your benefit is maxed out at that point, so don't delay. And by the way, he was going to file the next week upon learning that information. So if you start disability benefits before your full retirement age, your benefit will be reduced. That's not true. There's a carve out for disabilities. If you have a qualifying disability, you do not take that haircut. And last but not least, to receive a widow's benefit, you have to be married to your spouse for at least 9 months. That is true, provided you were married at the time of his or her death. So just to wrap things up, and I could turn it back over to you, Jeff or Lauren. What we discussed today is we talked a little bit about what Social Security is: a government-sponsored inflation adjustment lifetime income stream that when you look at it as a lifetime benefit, it's a very powerful asset for you and your family. We spent some time unpacking the 70-year projection on Social Security and what those numbers look like. So take that off the table and focus on something that you can control by understanding what's the maximum potential for you and your benefit, and making a wise decision when you start. So with that, I'll turn it back over to you folks. Thank you very much. I hope you enjoyed the presentation. I hope you learned a couple things. I hope we had a little bit of fun, and I appreciate you giving me an opportunity to talk to you all this afternoon.
Thank you. We're open for questions, and I don't know whether any have come in on the chat side. If you want to unpin Tom's screen, that would be great. And Tom, I do have just a thought, and I'll throw it out. And I know Anthony maybe can help us with this answer also, just to
Okay.
kind of kick off any questioning. But as we go through everybody's financial planning situations, they're all different. And we do run a Social Security optimization.
Yes.
So it does make sense, if you can afford it, to wait till 70. But I'd love to hear your and Anthony's input in regards to the different factors that we should be thinking about as we work through that decision.
Anthony?
Yeah, yeah, and those of you who have had this conversation with either Jeff or myself, I think you'll find it familiar to hear that I kind of break the Social Security question, the when question, really into two pieces. There's the mathematical piece, which is what Tom really dug into today, and that's just, a stone cold fact. Most of the time, you're probably going to be better off, assuming you have the assets to get you to 67, 70, whatever that later age might be. Most of the time, you're going to make more money. Of course, that takes into account life expectancy. And I know you have a lot better idea of your family history and, health issues than we do. So that's got to be taken into account. And that feeds into the second piece, which is the emotional side of things. I can tell you all day that you're 62 or you're coming up on 62 and you're saying, God, I've paid in my whole life. I just want to start getting that check. Who knows how long I'm going to be here? A bird in the hand is worth two in the bush. And I get that. And I can't necessarily argue against that other than to say, hey, here's what the math says. I understand where you're coming from. And if that's what you're going to do, that's what you're going to do. And we'll try to make a plan work around that, because we're always trying to work around what you want to do. My biggest, I don't even know if I'd call it an argument, but my biggest thought on why it's worth it to wait is your Social Security and your investments. So that whole piece of your retirement, both your income and your growth, your investments. I really look at that as insurance to a degree. It's insurance for what if I live too long. And it's easy to think of it as the opposite of life insurance, right? Because life insurance is there. Hey, what happens if something, I walk out of here and there's a bus coming down the street, or, something happens today? That's an easy fix. Well, I want to make sure my loved ones are taken care of. Well, it's kind of our job to take care of you and say, hey, what if we do make it to 90? You may not think, and I'll tell you, most people we work with don't think they're going to make it to 90, but a lot of you will. And that's a great thing because you have the assets to get you there. It's just we want to be as smart as we can about it so that once we get to 90, we're not sitting there and thinking, oh boy, I really wish I would have waited a couple of years. I would have been coming out ahead here. So I don't want you to make it think, wow, this is a life or death decision, because most of the time it's not. But it really can make a difference at the margins. And that's where we're coming in and trying to be an advocate on your own behalf, because we can look at it unemotionally. So we can give you that perspective. And those are the things I usually really try to hammer home. But Tom, what would you add to that?
The one, just a story, my mother-in-law, my father-in-law, they live in North Dakota. He's been working since he's a teenager. He's an egg banker. He works with farmers. He's never going to quit, right? He built his house with his dad in the 70s, right? They don't spend what they make. He has no intention of slowing down. His wife, Nancy, she took care of the kids. So she worked and she took time off to raise the 3 kids. And she went back to work. She was a postmaster in a small town, but it required her to drive roughly 70 miles round trip every day. If you know anything about North Dakota, it's Irish road truckers 6 months of the year, right? And the reason I tell you that, Anthony, is not to get too long-winded about a story, but it's a real-life situation. Up to a couple of years ago, until I informed her and taught her about some of these Social Security numbers, she agonized and worried day in and day out that she made the wrong decision, right? Where in reality, her worries was that she left money on the table and she couldn't take care of the family and she left something behind. Terry's was been the breadwinner for years, and his benefit was so much higher. In this case, it was like seeing the grandkids and getting off the roads, at 63 years old, so she didn't have to worry about that every day. So that's the one thing I'd add is sometimes sometimes there's other things that perceive maximize your Social Security, right? Whether it's icy roads or the fact, in this case, his benefit was higher, so it was irrelevant. So she worried all those years for nothing. And it's not life or death, like you said, right? It's to have an informed decision. That's the one thing I would add to that.
Bottom line, we don't, and you've heard me potentially say this before, we don't want you living off of hot dogs and beans waiting to get a higher benefit at some point in the future,
Right.
because none of us know if we're going to make it to some point in the future. So we can give you a math answer, and then you'll decide what's right for you. Somebody asked a great question. Will COVID-19 have any impact on Social Security benefits?
It's too early to tell. My guess is yes, it will. How much of an impact is too early to tell right now. But you have to remember they have 15 years to fix this. And we saw some of the minor adjustments, Jeff, can make an impact. In this case, $14 for every 1,000 earned. That alone extended the benefits, full retirement benefits, for 75 years. So I think at this point, the fixes are relatively easy.
I agree with you. It's very fixable. If anybody would like to kind of give us an idea of why COVID would have an impact on Social Security.
Well, I'll say just briefly. I think it has a two-pronged impact, and probably more than that. But I'm thinking on the top end of the spectrum and on the low end of the spectrum, because the first piece of this is we're seeing some loss of life here, and that's a way understatement. A tremendous loss of life in this country, and a lot of the people demographically who are passing away are Social Security recipients. Now, I hate to just put aside the human tragedy of it, but from a mathematical standpoint, obviously, if someone is no longer collecting, that is the system becomes more solvent, or it aids it in that way. The flip side of that, however, is the younger generations, or the working generation, the people who are out of work right now, and they may be on unemployment benefits, or they may be on whatever. We're collecting less taxes, right? People are getting laid off, therefore tax revenue goes down. So it's kind of a two-pronged thing. And I would agree with Tom that we don't know how those two things will balance, or if they will balance or not. My guess, and this is a guess, is that despite the reduction in the withdrawals, the loss of revenue may be a bigger hit, but it also will be a more temporary hit. Or at least we hope that's the case, with people gradually coming back to work here. So that's a long answer. And basically I said the same thing, which is we don't know, but those are the things to kind of think about here. There's pressure being relieved on one end and being put on more on the other end, and how those two things balance is what we need to figure out.
It's 20 million people are not contributing Social Security to the Social Security system right now, and that's a significant number. So, and right now, if I recall one of your slides, it was there are 3 workers, I believe, for each recipient.
Right.
It skews those numbers, so it bears watching. We've done a lot of talking. Are there other questions out there? Because I certainly have some I'd like to raise, but other questions out there that you'd like to ask? Anybody in our audience here?
Jeff, this is John Haley. I didn't know about the Medicare. I thought you had to apply at 65, but if you're still working, how late can I wait to apply for Medicare?
That was a good catch on your part, John. The answer, I'm going to tell you my answer, and Tom or Anthony may have a different answer. But if you are still working with an employer who has 20 or more employees, so most of you have come out of the public service sector, you do not have to start your social, and I should add, if your spouse is receiving benefits, that also will allow you to continue without starting your Social Security. Upon your separation from service, you'll receive a letter from your employer, which will state that you were part of this special group, that you now have the opportunity during the next 60 days to move to Medicare. That is what the rules are. So if you have retired prior to 65 or at 65, you must begin Medicare at that point in time, or you will be penalized. But, excuse me, if you're still working, the answer is no, you don't have to. And that is with that special group. That was a great question. Any other questions? Go ahead, Tom. I'm sorry.
No, I think you answered that very well.
So a common misconception, well, people think about other questions they might have, is that Social Security is either not taxed or is taxed at this incredibly higher rate. Tom or Anthony, could you give us some clarity around the taxation of Social Security? And by the way, there are two pieces to it. There's prior to between 62 and full retirement age, and then there's after full retirement age. So if you would help us there.
Anthony, do you want to go?
You go ahead, Tom.
Yeah, neither of you want to answer that one.
We have a document that I could send to you, Jeff, and it's a frequently asked questions document. I know I've shared it with you in the past, but here's how it goes. It gets a little complex. The Social Security benefits are tax-free up until 1993, when Congress passed a major overhaul of the program in an attempt to shorten Social Security's long-term financial outlook. Whether your benefits are subject to income tax depends upon two things: your filing status, if you're single, married, filing jointly, or married, filing separately, and your provisional income. Provisional income is determined by adding your modified adjusted gross income plus 1/2 of your Social Security benefit. And that's how you come up with the provisional income. So the filing status is, if you're single, up to 50% of your benefits may be taxable, from 25,000 to 34. If you're married, filing jointly, from 32 to 44,000. If your provisional income is taxed up to 85%, if you make more than 34,000 or more than 44,000, married, filing jointly. So that's
and just to clarify that point, Tom, it's not that you're paying 85% on your in taxes. It's 85% of your Social Security income is taxable at whatever rate you would pay.
Exactly. Yes, sir. That's correct. So that's how it breaks it down. A little complex, but it just kind of depends on what status you're in and then your income threshold at that time.
Yes.
Right.
So a lot of unique pieces. Well, maybe you're thinking of questions to ask, but for example, one might be, I have a relative who was married for 10 years, divorced. As Tom indicated, a very, very commonly overlooked benefit of Social Security is that you have an option to begin to utilize your spouse's benefit and not start yours till some date further into the future. So it can really provide a significant amount of leverage. Now, I'm sorry to report that your ex is not impacted by your starting or anybody starting that benefit. He or she will not know that you've even begun it, but that benefit is out there and absolutely should be looked at. And also be aware of the widow-widower type of benefit and the benefits that are there. In many cases, I've found that the what am I thinking of here? The facilities that are handling the funerals and things like that, they're very good about taking care of that, but know that that's going to be a benefit. Now, I have somebody doing my lawn. I'm going to go close a window. I'll be right back. Go ahead, Tom.
Well, and actually, I'll jump in here because what Jeff said, just kind of as an offhand comment, can really get quite complex. So he mentioned you can collect benefits on a spouse while suspending your own benefits. And this, it used to be more true than it is now because the government closed a few of those options. They would call them loopholes. But I was just looking up the cutoff date. So one of the rules got changed for everybody, so it can't. But there are still, and I believe it's if you're born before 1954, I believe is the year.
It's the file and restrict, right, Anthony?
The what?
File and restrict rule?
Yes, exactly.
Yeah, you had to be 62 as of January 1st of 2016.
Yes.
That was the cutoff. Yep.
So if you were 62 before January 1st of 2016,
right,
you have the option, and we've done this with a few clients, really planned it out, and it really makes the most sense when one spouse earns a lot more than the other.
Right.
But let me sketch the scenario because this is a real scenario that we've worked on. Let's say the wife's Social Security is much higher than the husband's. She just was the higher earner throughout the course of their lives. And the husband, maybe he takes his Social Security at full retirement age at 66 or 67. The wife then just files a restricted application for her spousal benefit, but not her personal benefit. So the husband's getting his full, and let's say to give it a number, it's 10,000. So he's making 10 grand a year. And so she's making half of that. She's making 5 grand. So they're making 15 total. And they do that, and let's say they're the same age, just to make my example simple. And they do that for 4 years until the wife turns 70, where she would get her maximum benefit. And let's say that number is 30,000. So for 4 years, they've collected 15,000 a year together. His 10,000, and she gets half of that, so 5,000 on top of it. Then at age 70, they reverse. So the wife is now getting her full 30,000 as her benefit, and then the husband files for his spousal benefit and gets 15. So now they're making 45 a year. Now they could have each filed independently for their own personal benefits, but since the spousal benefit on the wife's account was higher than the husband's personal benefit, I realize I'm using a lot of pronouns here. Should have given them names to make the example more colorful. It made sense to do the lower earner files first, the spouse files for spousal, and then at age 70, when that bigger benefit has accrued to the maximum possible amount, you flip-flop. And that is a strategy that is available to some people still. Now, again, you had to have turned 62 before January 1st of 2016. So if you're younger than that, congratulations, but this doesn't apply to you. But we have done this. It's complicated, but it's not hard per se. It's just you really want to plan this out.
And it allows a larger benefit to earn that delayed benefits, which we saw in the example with Archie and Edith, could really add to their lifetime benefit amount, right?
Right.
Just as a reminder, this was recorded. So if there are things that you'd like to go back and listen to once again, Lauren, within the very near future, will have this posted on our website, and you'll be able to access it.
I had a question, Anthony.
Yeah,
So right now I'm getting my Social Security, and I have since 62. And then when Dave retired, he started getting half of mine. So when he's turned 70, then I can start getting half of his?
Well, I believe we had, and the age thing is one piece of it, but I don't know if you had to have specified that you had to file a restricted application at the time. Tom,
We went to the Social Security Administration office, and that's just a nightmare. Can you help us with that?
Yeah.
Okay, perfect.
Yeah, so let me look at your case individually, and
Okay.
I'll get some information out to you on that.
Okay, great. Thanks.
Other questions? Such a simple thing where we used to say, hey, I'm 62, I can start. And there is so much more to it. And so many people have left so much money on the table. And it's not necessary. In many cases, we may advise you to utilize other assets because, for example, if the numbers work, just to give you an idea, Social Security from 66, if that's your full retirement age, till 70, will grow by 8% a year, that benefit number. And certainly, especially in today's world, we know how difficult it is to generate 8%. So for those of you that have not begun to utilize your benefit yet, these are all things that are so important to be factored in. Any other questions for any of the group here? Well, this has just been a treat for us. Lauren, this is going to be posted where?
To our YouTube channel, which will also be linked to our socials and our website.
And our website is steinfinancialgroup.com.
That's right.
And timing to get this up will be about when?
A few days, shouldn't take me too long.
That sounds great. I appreciate it. And I appreciate everybody taking the time to be with us today. We look forward to seeing you at our next function. And do we have something on the calendar yet, Lauren?
We've got plenty on the calendar, but nothing solidified dates. But you can find all of that information on our events tab on our website.
Beautiful. Tom, thank you for being with us today. We truly appreciate it. Thank you for being such a good partner. And thank you for everybody on this call for being such a valued piece of what makes us who we are. So thank you and be well. We look forward to talking to you soon. Bye-bye.
Thanks, everybody.